Share Navigator, and this video here is a very brief tutorial based on a question we got earlier on in relation to how to estimate probabilities of trades working out for us. So if you come into trading on the Interactive Brokers website and platform demos, at the moment they have a beta test of a product called a Probability Lab demo. So we're going to click on try demo and we'll talk you through it at the moment. Now, this can be used to create complex trading strategies. Takes a bit of getting used to, but all I want you to do for now is to use it for understanding the probabilities of success. And the probabilities of success are based on a number of factors: historical price movement and, of course, implied volatility. So implied volatility is really, really important to any stock. This is why you're going to hear me over and over and again saying when implied volatility rises, sell options, and implied volatility falls, that's when you do debit spreads. So there's time to do credit spreads, there's a time to do debit spreads. So on the top left hand corner here you can see the particular stock. So for example, we're going to change that to Oracle. And then it has the options expiry dates here. So we can change them to whichever one we want. At the moment it's on April the 17th, so we leave it at that. Now, a couple of things just to be wary of when you start playing around with this. The way it's laid out there at the moment, that's the current volatility based on current volatility here. But we could actually manipulate the volatility based on what we think it's going to be over a period of time. Now, we're not using that system for this right now. This is not the purpose of this particular video. All I want you to do is to find out how do I estimate whether a stock is going to finish above or below a certain price. So if you look at down here at the bottom, we have here 38.50, 39, 39.50. That's the potential. They're the strikes of Oracle, if you like, based on probabilities between now and April the 17th. All right, and just above that you'll see percentages. And this is cumulative right up to the top here to 100%. And this is what they're saying here is, for example, there's only a 1.93% chance of Oracle finishing below 38.50. There's a 2.5% chance of it finishing below 39, a 3.4% chance of it finishing below 39.50, and so on and so forth. So for example, we recently did a bull put spread on Oracle for 41.50 for stroke 40.50. And at the moment, there's only a 16% chance of it dropping below that. That means we've actually got an 84% probability of success. So our trade that we put on, we need Oracle to finish above 41.50 by the 17th of April. And at the moment, the way it's shaping up, we've got a good, strong possibility of being in profit in that trade. So we've 84%. Let's say on the flip side, you wanted to do, let's say, a bear call spread or identify what the chances are of something finishing below a strike price on the upside. Well, let's say for argument's sake we looked at the $45 strike. Well, the cumulative effect right up to that is 92%. So there's a 92% chance of it finishing below 45. That means there's only an 8% chance of it finishing above 45. So that's how simple it is to use this probability calculator. So if we change the time frame on this, so we look at 45 again, at the moment between now and April the 17th, it has a 92% chance of finishing below 45. If we actually change that out, for example, to April the 10th, you're going to see that the chances have increased dramatically because there's less time. If we actually increase the time frame, let's say to May the 15th, we look at this 45, all of a sudden you've only got a 78% chance of it finishing below 45. So that's why the strike expiries are very important to look at when estimating probability. This is Stephen Cox from Share Navigator. This is a very simple tool to use for you to estimate your probability and chances of success. Please be aware though, when you're doing credit spreads or debit spreads, do debit spreads when volatility is low and do credit spreads when volatility is high. That's a simple rule of thumb. Thanks and bye for now.